Good day, everybody, and welcome to the LPL Research Market Signals podcast. I am Mark Zabicki, Chief Investment Officer of LPL Financial. Joining me today is Lawrence Gillum, Fixed Income Strategist. Lawrence, how are you doing today?
I'm doing well, Mark. We're seeing some positive action in both the equity and bond markets, so that makes the day a little bit easier.
Yeah, indeed, and we're going to get into some of that. So just a note for the audience, we are recording this on Tuesday, October 4th. So as you see this, open up the podcast. It is recording Tuesday, October 4th. So just in terms of the disclosures that we're required to show, these are the various disclosures for the Market Signals podcast, and then let's just talk about, Lawrence, a little bit of what happened last week. I know we're going to get into what's happening over the last couple of days, yesterday certainly, and today so far, and we've got some notable commentary around that. But I just want to touch on some of the moving pieces drove markets last week, and actually really ended markets last week on a down note overall for the month of September. But a lot of news was coming out of the UK regarding what was happening with the British pound and also with gilt yields, and LDI strategies within pension funds. So can you kind of give the folks in the audience a little bit of a breakdown as some of the moving parts that were happening in the UK?
Yeah, for sure. It looked like the bond vigilantes were back last week as it related to the UK gilt market. The Liz Truss government unveiled the kind of a surprise mini budget that turned out to be anything but mini as it related to expected tax cuts, and that caused a broad-based sell-off in the gilt markets. We saw yields on longer dated gilts up by 125 basis points over the course of a couple of days. It's important to remember bonds are financial obligations. So when we see that type of move higher in yields, that tends to cause stresses in other parts of the market, other parts of the economy. And that's certainly what we saw as it related to these LDI accounts, these liability-driven investing accounts. These are pension funds that are really big and popular in the UK, where they own long-dated gilt securities to kind of offset their longer-dated liabilities as well. And when you see a massive sell-off in these markets, a lot of times, particularly if they are levered, which it seemed like they were, that caused the potential for margin calls. So the Bank of England was really backed up into a corner here and offered to intervene and try to settle down the gilt markets. But that certainly had kind of rollover impacts into our markets, both on the equity markets and on the fixed income markets. We saw Treasury yields here in the U.S. spike higher right after that announcement as well. So that was an unexpected kind of fiscal policy. We'll call it a mistake, frankly, that unsettled markets and caused a big sell-off in fixed income markets and equity markets last week.
Yeah, and since then, the UK government's kind of backtracked, have they not?
They have indeed. There was a tweet, I think it was yesterday morning, from the chancellor saying that we get it and we have listened, and they're gonna remove that tax cut from the budget. And it seems like things have settled down a little bit. Certainly in the rates market, we've seen yields lower in the UK market as well as in the US market as well. And then of course the equity markets appreciated that backpedaling as well. And it seems like a lot of that fiscal kind of uncertainty that was caused by the UK has kind of been removed, at least for now.
Yeah, agreed. And just, notably, I think it was from the 27th through the 22nd through the 27th of September. I think gilt yields moved about 100 basis points from 10-year gilt yields, that is, from 3.5 to about 4.5, causing the distress and then thus the intervention from the Bank of England. On this side of the Atlantic, we did get some consumer confidence numbers that were higher than expected. So what you're seeing here in the slides that we're showing for those who are sort of viewing this podcast, consumer confidence was 108 versus the expectation of 103.2, so better than expected. Q2 GDP in the U.S. was effectively as expected, negative 0.6, right in line with the consensus. And then the GDP price index quarter over quarter was actually 4.7% versus the 4.4% expectation, which caught the market just a little bit off guard. And as we continued at LPL Research to look at for further signs of a deceleration in inflation and inflation moving in a downwardly direction, that was a little bit of a shot to that expectation. But I don't know that the GDP price index is broadly followed, but it's something certainly to pay attention to. And let's move to the Federal Reserve policy overhang, Lawrence, and I know the notion of this has kind of changed a little bit over the last 36 hours. But Lael Brainard's speech, where she acknowledged a stability concern, particularly in emerging markets, that may be being caused by some central bank policy activity, but still pressed on the notion that rates should indeed go higher. So how is that playing out over the 36 hours in terms of what the UN has had to say, et cetera, et cetera?
Yeah, for sure. It does seem to be that there's kind of a break between certain members within the FOMC. The FOMC is the monetary committee that manages the short-term interest rate hikes, and there seems to be like a group of folks within the FOMC that want to go more aggressive. They want to continue to raise rates at the current pace and current magnitude and get to what they call tight monetary conditions as soon as possible. Where then you have others like Lael Brainard and some other folks that are saying, we've already done a lot, and maybe we'll continue to raise rates, but maybe we don't need to go 75 basis points every meeting, because there are, inevitably there's going to be spillover concerns into other parts of the world. Kind of what happens here in the interest rate market doesn't stay here. It does impact other locales as well. And that was followed up, I think it was yesterday, by a UN concerns about the elevated rate hiking campaign that's going on globally, frankly. And the UN was cautioning that, again, there will be financial stability concerns if the Fed and other central banks continue to raise rates at the pace that they are currently raising rates. Because one thing to remember too about rate hikes is that they do have a long and variable lag time. So a lot of these central banks have only started raising rates over the past 6-7 months, and those rate hikes haven't really filtered into the real economy yet. So there's the potential for over tightening, I would say, particularly at the rate and the magnitude that we are seeing rate hikes. But it did cause maybe some discussion within, I think, some of these central banks, and certainly we're seeing it in the market pricing. And maybe the Fed doesn't have to go 75 in November. They likely will, but I think that does put some additional doubt into markets. And if there's any sort of kind of slowdown in rate hiking expectations, that's tended to be good for risk assets and frankly for Treasury market yields as well.
Yeah, and I think the market has been pricing in this expectation, and we've talked a lot about it in terms of conversations that we have weekly in our strategic and tactical asset allocation committee, is that I think the market's pricing in the fact that the Federal Reserve is absolutely and utterly not going to blink at all whatsoever. And that may generally be the case, but I mean, I think what the UN statement raised was it reminded folks of the possibility that the Federal Reserve could slow down. And you mentioned before we got on, the Bank of Australia actually did a little bit of a less of a rate hike at 25 basis points versus the 50 basis point expectation. So I think it just reminded folks that there may be still that possibility that central banks are going to blink here. We're good right now. We're really kind of taking them at their word, but that perhaps the markets were overpricing the fact that all central banks were going to plow ahead, and that's why the UN statement perhaps caught markets off guard just a little bit. So just talk about. I'll just cover off on the S&P 500 index through 9 months, historic We've talked a lot about it really at an ad nauseum level in this podcast and other things that we do. Third worst performance through 9 months since 1931. That's according to Bloomberg. That is outstandingly bad. What makes it worse, honestly, Lawrence, and you can speak to this, is we haven't gotten any respite from the fixed income markets. So I don't know that I've got similar statistics off the top of my head through 9 months, but just again a brief comment on fixed income performance has really offered folks really no safe haven through the balance of 2022 so far.
Yeah, and that's been the problem, frankly, that equity markets, they do go through these periods where you see these drawdowns, and usually and historically anyway, bonds have been there to help support the negative price action that we see out of equity markets. They just haven't played that role this year. This is the first time since I think 1976 where we've had 3 consecutive quarters of both negative stock prices and bond prices. So this is kind of the longest streak of bonds not playing that traditional role within the equity market drawdown. So I think that makes it tougher for a lot of investors out there to see their statements. They had a diversified asset allocation, and frankly, the bonds weren't there to provide that support that they have historically. Now, we do think that relationship, or the ability for bonds to play that diversifying role, has improved with these higher yields, but that hasn't helped, certainly over the past 9 months for sure.
Yeah, and that's probably working a little bit better over the last couple of days. But as kind of now bonds are getting, people are recognizing the opportunity that perhaps has been afforded them in bonds based on the activity that we've seen, historic activity we've seen in fixed income. Let's just turn the conversation into what people can expect, this week in terms of U.S. economic data. ISM was, actually a little bit less than expected, which, may feed into some of this activity that we're seeing in risky asset prices. However contrary that may seem, because we are getting a slowdown in activity that the Federal Reserve clearly wants. Lawrence, before we got on, we talked about this morning's JOLTS job openings number, which was about 1 million light versus expectations. Again, the Federal Reserve's work is basically focused on the jobs market and correcting what they term as an overly tight jobs market. JOLTS job openings that are coming in less than expected. So that number was about 10 million versus the 11 million or so expected. It's coming in, that lower than expected number is actually, feeding into the concept that the Federal Reserve is actually, impacting the economy in a way that was expected. And then just as we look throughout the balance of the week, PMI numbers are always important. ISM services number, initial claims on Thursday, again, always important. And then on Friday, we actually get the U.S. non-farm payrolls number, which is now getting an expectation or a consensus forecast of 290,000 jobs to be added to the economy. Prior number was 308, and the employment rate as of today is expected to stay steady at 3.7%. And in international economies, it's really all about PMI and manufacturing activity across major areas of the non-U.S. globe. We pay specific attention to kind of the Eurozone broadly. So I've highlighted in the previous chart and also this table some of the more important numbers that people pay attention to in terms of what's going on, not only in U.S. economics, but also international economics, as well. So the PMI numbers are going to be key for people to keep an eye on as we pace through this week. In terms of other issues that are likely going to drive conversation, we've touched a little bit about the UN statement and the perhaps change in some level of expectations that may be occurring in terms of the way market participants think about central banks. we mentioned already that the UK government's kind of backtracked in its plan for a tax cut, and that has also improved market conditions in the pound and also reduced gilt yields. Um, we went into the week focused on some UK and Eurozone bank distress, and that conversation was prompted by some news coming out of Credit Suisse, and also just by the general problem in the UK, and the pension funding, and the LDI issue going on in the UK. So that's, although some of that talk has been a little bit washed away by some of the market activity over the last couple of days, still something to keep an eye on in terms of whether central bank activity is going to actually start breaking things. So you keep an eye on that in the UK and the Eurozone, because I think it's a general consensus view that the banking complex in the US is much stronger than it is in the UK and Eurozone. So if something is going to break, it may come out of the UK and the Eurozone first. Notable earnings. People are going to be pay attention likely to pricing input costs and volume, just from like an inflation perspective. So Constellation Brands, McCormick, and ConAgra are set to report this week. So three notable companies that you may want to keep an eye on. And then obviously tomorrow's, as we sit here today on a Tuesday, tomorrow's, which is Wednesday's OPEC Plus meeting, where the broad expectation is that members are going to discuss a potential production cut of approximately 1 million barrels a day, which is just a little over 1% of total global production. Just in terms of that talk of the OPEC meeting, or what may come out of the OPEC Plus meeting on Wednesday, it's caused a little bit of a bounce, as we can see here, in oil prices. Not dramatic, and it really hasn't changed the narrative around decelerating oil prices, which, oh, by the way, is beneficial for our inflation story and the globe's inflation story. But we've been discussing commodities here in this forum and other forums for the last several months, indicating that we believe the commodities trade is perhaps over in this cycle. At least the best of that trade is perhaps over in this cycle. So here we're looking at WTI Crude Futures that are really giving no indication, at least so far, that technically it's ready to recognize a material rebound. And certainly the trend is not your friend in this case. We've also talked about, and again, in this forum and other forums, the bearish sentiment that we were recognizing in markets, dramatic bearish sentiment we were recognizing in markets over the last several weeks or so. I mentioned this in our Street View video. So historic levels, bearish responses to the AAII survey, and this chart goes back 10 plus years, 12 years. So we reached bearish responses in the AA survey that we haven't seen in the last 12 years, which is a notable outcome. We think people should be paying attention to. So effectively, what you're getting out of this market so far today and also yesterday was a UN release, effectively the UN statement, a change in central bank expectations, perhaps just a little bit, coupled with an overly bearish sentiment framework that's helped cause some of this rebound in the market, again, so far over today and yesterday. If I further that notion just a little bit, again, when you look at not only the AAII survey, but a percentage of S&P 500 index constituents with new 4-week lows, again, that reached levels that we've only rarely seen over the last 20 years. And those instances were 9/11, the GFC, the Greek Eurozone contagion, effectively, obviously the COVID pandemic, and now in 2022's inflation discussion, inflation dynamic, which has driven historical bearishness when it comes to this particularly indicator. And last, and by the way, when we created this chart on Friday, we labeled it tactical bounce pending. We perhaps have gotten our answer to that already. This just furthers that conversation. Percentage of S&P 500 index constituents with new 4-week lows. We discussed that, but we're looking at RSI here on this chart again at a historic low relative to the recent past, and percentage of members with prices greater than the 50-day moving average, that is at a trend low here. So again, this market was setting up for a rebound. It took a little bit of news out of the UN in order to perhaps get us there, but we were in a condition that was dramatically, oversold. On the inflation front, because we added this chart, so Lawrence, and I'll ask for your view here in a second, but again, our view as a strategic and tactical asset allocation committee is that inflation has already started to roll over, and perhaps it could pick up speed over the next several months. We will see. We would expect some of the Federal Reserve work so far to lead to perhaps exactly that. But and Lawrence, just in terms of how the bond market is viewing this construct in terms of a potential trend change in inflation, what's on your mind in that regard?
Yeah, so obviously inflation is the big concern for fixed income investors, because higher prices with fixed coupons means you're getting less of purchasing power. So bond markets are hypersensitive to inflation and expected inflation. And one of the interesting developments in the bond market is, if we look at the difference between nominal Treasury yields and these Treasury inflation protected security yields, that comes up with a break-even analysis, or kind of what market is implying the inflation expectations will be over a certain amount of time. These market implied inflation expectations have really fallen off a cliff. Back in March of this year, markets were thinking that inflation over the next 2, 3, 5 years was going to be significantly elevated relative to the Fed's 2% target. Now we're seeing 3, 5, 10, 30-year kind of time periods back in line with that historical 2% target that the Fed's aiming for. So whether the actual realized inflation gets back down to that 2% level, bond markets are forecasting that the Fed is going to be successful in their rate hiking campaign, and arrest these generationally high consumer price increases. So right now, the bond market isn't worried about inflation lingering or coming this new inflation regime where we have 4 or 5% inflationary pressures on a go forward basis. The bond market is kind of signaling that the Fed is going to win this battle.
Yeah, and indeed, and just in terms of some of the forecasting that's going on by economists in the industry. I mean, it's given that we've effectively shut off an economy and turned it back on. Economists in general are trying to get their bearings around setting forecasts for a number of data series, inflation being one of them. So I referred to the GDP price index earlier and the fact that it was higher than expectations. Well, I mean, it's been such a moving target, not only for inflation, but PMIs and et cetera, et cetera. We're seeing, sometimes numbers being very different than the consensus estimate. And that's just because we're trying to get our hands on what's going on in this economy. Again, when you turn it off and then turn it back on, dramatic things can tend to happen, and we're certainly seeing that. So want to also touch on the activity that we're seeing in fixed income, Lawrence, and at the strategic and at tactical asset allocation meetings that we have every Monday, we've talked about duration quite a bit. And recently, in yesterday's meeting, we also talked about our S&P 500 index target and whether that body should change that target level. So more on that to come. But in terms of duration, I think we've been waiting for this time, Lawrence, and I know that you talked a little bit about this this morning in the morning call, but we've been waiting for a time to increase duration based on a market that may have reached somewhat of an irrational state. Maybe what do you say to that?
Yeah, for sure. We definitely have changed the way we're thinking about the fixed income markets, given the big backup in yields that we've seen. So what we're showing here is we have updated our 10-year Treasury end of yield forecast. Coming into frankly the last couple of weeks, we were thinking maybe yields can get back to 275 to 325, but with this prolonged inflationary battle that the Fed is determined to fight. With the release of their latest, Fed funds forecast, we have changed our view marginally. Here in LPL Research, we do use a lot of these quantitative tools and models to inform our decisions. And for these interest rate forecasts specifically, we use a lot of these econometric models that allow us to look at the relationship between some of these fundamental factors like economic growth expectations, inflation expectations, kind of Fed terminal rate, foreign demand, equity volatility, et cetera, and how that relates, or what that relationship is to Treasury yields, and that allows us to kind of model out those relationships, which allows us then to stress and provide a forecast for 10-year Treasury yields. So the big change that we've really seen recently, when we plug in this new Fed funds terminal rate that was released, I think it was a couple of weeks ago by the Fed, with a higher than expected Fed terminal rate. Now that the FOMC thinks that the Fed terminal rate is around 4.5%. So when we plug that into our model, we do come up with a kind of a fundamental fair value number of 3.5% on the 10-year Treasury yield. But then what we do is we stress those factors under 10,000 different scenarios to come up with a range of potential outcomes. We know that point estimates in this business are popular, but they're not very precise. The markets are too volatile for that type of precision. So we do want to have a range of potential outcomes. So we stress these models and these factors 10,000 times and come up with a range. So that range is now determined to be 3.25 to 3.75% for the year-end target. We've seen a big move in yields already, and that kind of relates to our second decision that we've made recently, and that is to kind of neutralize our underweight duration positioning within our tactical asset allocation portfolios. So if you want to go to the next slide, we've been running model portfolios that were underweight duration. We've had about a half a year underweight to these within these portfolios relative to our index, which is the Bloomberg Aggregate Bond Index. So we've kind of kept that underweight bet in place until recently, where we did want to neutralize that duration allocation because of just the move higher in yields. Recession risks are increasing given the global coordinated central bank tightening that we're seeing. So we want to add that interest rate risk, which tends to offset that equity risk within portfolios. And we also think that we also want to take advantage of these higher yields. So we did decide as a committee to neutralize that underweight duration bet. We've seen yields move significantly this year. If you think about where we came from back in August of 2020 at 50 basis points, we got as high as close to 4%. So which is one of the largest moves higher in the 10-year Treasury yield since 1983 and 84, right? So we've seen a big move out of Treasury yields already. So we do want to take advantage of that. We also tend to see, Treasury yields peaking before the Fed gets done. We're not saying the yields are going to peak at this point, because there's just a lot of illiquidity and volatility in the Treasury market. But we do think that the big move higher in yields has already taken place. So we do want to take advantage of that move higher.
Yeah, Lawrence, and again, the Strategic and Tactical Asset Allocation Committee has been talking about this for months. And looking for the right time to make that duration change. As we got some of that, that upside activity lift in 10-year Treasury yields at 4% ish, in the last couple weeks, we thought now was the time. And you raised a good point. Is that typically yields peak before the Fed actually gets done with its work. Given that historic trend, maybe that happens again, and we've got this pinpointed fairly well. We look good over the last couple days, so we'll see if that continues. You never want to hang your hat on that, though. Let's talk about high yield, which is an interesting space in terms of what some of these companies have been able to do. In the low interest rate environment, directly around COVID. So speak to that a little bit, Lawrence.
Yeah, for sure. The high yield corporate credit market is an area that we've kind of legged into a little bit here in our tactical asset allocation models over the past few months. I would say in that we have seen higher yields, and we certainly want to take advantage of that. We're not going all in on high yield at this point, but we do think it is a pretty attractive opportunity if you have a holding period that's measured in years and not months, particularly because we think that the default expectations have really been overblown in the high yield corporate credit market. Market implied default rate over the next 12 months is between 7 to 8%, depending on how you kind of measure recovery rates and liquidity premiums. But if you look at this top chart, the top chart is showing how much of the existing debt has to be paid off over the next couple of years, and then kind of what needs to be rolled over, and how much of the market actually needs to access the capital markets to pay off some of this debt. And companies have done a really good job of taking advantage of low interest rates. They've termed out their debt, meaning they've extended the maturity on a lot of this debt. So less than 6% of the existing high yield market needs to access the capital markets over the next couple of years, less than 8% if you go all the way out to 2024. So the fact that markets are pricing in a default rate of 7 to 8% when these high yield companies don't need to access the capital markets like they have in the past, we think that some of these spread widening is overblown. And the bottom chart is just to kind of reinforce the fact that these companies have taken advantage of lower rates and easy access to capital markets. The amount of debt that's been issued over the last couple of years, over $400 billion of debt was issued in 2020 and in 2021, which was the most on record, at least over the past decade. So, the financial stability of the high yield corporate credit market is in pretty good shape. And because they don't have to access the capital markets anytime soon, I think the maturity wall here we're showing is 2029. That's when a lot of that debt becomes due. We think that there's going to be a pretty good opportunity to take advantage of these higher yields and higher spreads that we're seeing in the high yield market.
Yeah, and I think the message is that we, as you delivered, Lawrence, is we would wade in here just a little bit. I mean, you're likely going to continue to see volatility in this space as the market kind of figures this thing out a little bit. The funny thing is we've talked as a research department and as financial advisors and fiduciaries for a long time about where are we going to get income? Where are we going to get income? Well, now's an opportunity if you can stomach some near-term volatility to put some income away in the high yield market. Obviously active portfolio management is what you want to do in high yield. So there is that, but you do have an opportunity here in terms of the strength of some of the balance sheets in high yield, and also some of the yields and spreads that you're seeing in high yield to actually do some work and put some income into your portfolio and be glad you did over the next several years. At least that's the way we think about it. Lawrence, I want to thank you for joining us, folks. Thank you for joining us as well. Wanted to try to give you a little bit of insight in terms of what we're thinking on a day-to-day basis at LPL Research, and what issues are driving our conversation in terms of our strategic and tactical asset allocation committee work. So have a good day and have a good week, and we'll see you next week.